So what is a futures contract anyways? I'll give you the basics here in under 5 minutes. Let's start with a definition. Let's define what it is we're talking about. It's an agreement traded on an organized exchange to buy or sell assets, especially commodities or shares, at a fixed price, but to be delivered and paid for later. Let me give you an example. Corn, for example, farmers back in the day, this was initially designed way back when so that farmers could hedge their bets early on their harvest. If they were really uncertain about prices upcoming in the future during or before their harvest, they could contract with a speculator who would then give them X amount of dollars for their corn today for them to deliver after harvest at a specific contractual date in the future. The farmer is going to get the cash now. The speculator gets the prospect of future higher prices. It's a win-win. Both are free will entering into a contract of their own accord. So what else is it? How is it used today? It's kind of morphed and developed into more than just a corn futures contract. It is a levered asset class. It means you can control a lot of assets with very little money up front. Example, on the S&P 500, it's the most liquid contract, the most liquid asset on planet Earth, essentially, at the moment. That is, at today's closing price, trades at $4,573 and a quarter. It represents a valuation of 50 times of its actual assets. So every contract is worth $228,663 at the end of close today. And the margin requirements to control that kind of assets is $14,000, roughly $500 to trade one. And not to mention all of the other discount. That's a full discount, or that's a full brokerage account. But if there's a discount broker out there, they do offer less on the requirement side. So this means every 1 point of movement on the S&P 500 is worth $50 or $12.50 per tick. So in other words, $10 per move on the SPY, which is the S&P 500 ETF, which trades just like a stock. Every $10 move on the SPY is worth $10 per share. Every $10 of move on the ES is worth $500 per contract, to give you a size and scope of what we're talking about. Okay, let's go into showing you exactly what this looks like. Hang on, let me pull up. Okay, so here are some of the other platforms, or not platforms. Here's the other futures contracts out there. You've got indices, you've got energy, crude oil being a popular one, gasoline, RBOB, ethanol, natural gas. You got some of your commodities, your cocoa, your cotton, your orange juice, your coffee. You got metals, you got your gold, your silver, your platinum, your copper, palladium. You can either get a live cattle, you can get a feeder cattle, lean hogs. There's future contracts on just about everything, even currencies, the US dollar, the euro, the Japanese yen, the British pound, and so on and so forth down the list. There are just a ton of different futures contracts out there. Each of them has their own scale, their own margin requirements, and what it is that we're magnifying on a investment level. So let's go through that here real quick. On a couple of them, S&P 500, like I said, margin requirements $14,000. That was close, $784, and we're talking $12.50 per tick, per quarter tick, or per quarter point, which is a tick, which is $50 per point. And the NASDAQ has similar structure as well. Let's go down to that one. NASDAQ, you must have a margin requirement $22,178, and every quarter point is worth $5. Every point is worth $20 on the NASDAQ. And so the scales work the same in the exact same. So when you are trading a futures contract, you are trading a levered asset classes, and you're controlling a lot of assets with very little money. If you like this and you want access to the tools, check out Ninjacators Fast Track with the link below.